Okay, so move on to the last question here. Hi, Dave and Andrew. I just finished listening to all of your episodes. Thank you for this amazing resource. My question, I know Andrew is very anti-debt, so I wonder what he thinks of Lowe's and Home Depot's extremely high debt to equity ratios. From what I can tell, people generally agree these companies are strong choices for investment, but their debt scares me off from buying. Why is it so high compared to other retail? Any advice would be appreciated. Thanks. From Daniel in Atlanta. And Daniel, I've been asking myself this question for months,
Months.
months and months and months, and I don't know why they do it. It's just this the way that these companies are. Maybe they can get away with it. I don't know.
Mhm.
They do seem really safe in the sense that, like, by all traditional metrics, they are safe companies. Like Moody's, you talked about Moody's a couple weeks ago. They rate the debt until they basically try to determine how risky that debt is, and they give Home Depot, I think, like an A rating, or it's a good solid rating. And so if these companies were to continue driving the kind of sales that they do and that they have for a long time, their debt shouldn't be a problem. It's just sometimes you can look at some companies and they can be a little bit more aggressive with how they're choosing to keep money in their business. So like Home Depot and Lowe's as another example, they don't keep much cash laying around and they don't keep a buffer for short-term stuff. So that's usually not a problem. If the markets are working healthy and there's a lot of liquidity and everything's running smoothly, that's never a problem. And that's probably the market majority of the time. So it really comes down to, is the way that they're choosing to have so much debt and choosing to have, and it's not so much even like the debt itself, it's just they don't keep assets. So I don't want to get like super into the accounting, but basically they are very aggressive with buying back stock a lot more than some other companies are.
Mhm.
And I'm a huge advocate of buybacks. Most of my portfolio have stocks that do stock buybacks. I think it's a great way to give money back to shareholders, but they're very, very aggressive. Over the last 10 years, Lowe's has done it. They've reduced their shares outstanding by like 5% a year
Wow.
on average over those 10 years. To give you perspective, if a company reduces it by like 1%, that's considered pretty high.
Mhm.
So try 5 times that and try it over a 10-year period. Home Depot, similar story, 4%. So they're just buying back a ton of shares. And, it's one of those things they probably don't see any competition around the horizon. So they don't feel like they need that money. So they buy it back. And that makes the stock price go really high. And that's a big reason why, especially Home Depot, has done so well with their stock price, is because they continue to buy back stock. So for me personally, I mean, I haven't pulled the trigger yet, obviously, on either of those companies.
Mhm.
And a big part of that is because both in the short term with how much like cash they keep around in the books versus how much they have to pay on stuff. They don't keep a lot, especially compared to other retail, just like Daniel said.
Mhm.
So that's one reason. The second reason is I don't know how sustainable these buybacks are. And for those reasons, I haven't pulled the trigger. And you really do have to take it on a case by case basis, because I do have another stock in my portfolio that's very aggressive and they kind of a similar story. I just kind of see their revenues as more stable than in a worst case scenario what a company like this could be. Doesn't mean I'm right or wrong. It just kind of shows you where my comfort level is.
Mhm. All right. So that kind of leads me to the next part of the question. So he asked about the high debt to equity ratios. And I guess without getting into the nitty gritty of that, could you kind of explain a little bit like what a debt to equity ratio is and maybe allude to a little bit what he's talking about here?
Yeah. So it's all just accounting, right? And so it kind of goes back to what we are saying about what you can do with the money. We
Mhm.
said how you can kind of spend it, you can invest it, or you can keep it. So cash is an asset. I think we can all agree on
Agreed.
that.
Yeah.
And then you have expenses, liabilities. So that's on the other side. You have assets, you have liabilities. Whatever is left is your equity, similar to the way we have home equity on our homes.
Mhm.
So remember how we said the company wasn't keeping a lot of cash. They were spending it on buybacks and lots of it. So when you do that super, super aggressively, your equity goes down. You contrast that to a business, let's say like Microsoft, where they're building up a bunch of data centers
Mhm.
to have a bigger reach so they can reach more cloud customers. Those data centers are assets. So instead of that cash maybe going to a buyback and going away from a balance sheet, it's added to the balance sheet and it's an asset and it increases their equity. So that's kind of the difference where you'll see companies that buy back more. If they're very, very aggressive with it, they'll actually be shrinking their equity. And that's why you see the debt to equity go so high, because the equity part is so low.
That makes sense. So in essence, when you see something maybe that looks a little out of the norm for a particular company or even a sector, it probably behooves you to look a little deeper and try to uncover maybe why that is.
Yeah. And I think it's a great question to ask. And the fact that it rose red flags, I think, not to say that this is a bad situation. It's just you have to ask yourself, what kind of companies do I want to invest in? And I think buybacks are good. And I think companies that stay in their lane are good.
Mm-hmm.
And I struggle with like how to talk about this because they've been great stocks, and I've been looking at them for a long time because they're great businesses. I mean, Home Depot is like the Costco of home improvement retail,
Yeah.
so they're great businesses and they could conceivably do this for 5, 10, 20 years still.
Mm-hmm.
We'll see. It's just something that Buffett said that I came across recently. He said, one of the things that I do is I try to reduce catastrophic risk.
Mm-hmm.
And I think some of the turbulence we've seen lately kind of underscores some of that with some of the geopolitical risk. And this is just one form of that. So you have to ask yourself, is that a risk you're happy taking or not? I think their businesses will be fine. I just don't know how sustainable 5% and 4% of shares outstanding every year. Those are huge buybacks. I don't know how sustainable that is.
Yeah, those are definitely big boy numbers.